People love to complain about taxes. They curse at the government. They blame politicians. They say life is unfair. But here's the uncomfortable truth. Most people don't lose money because the tax system is evil. They lose money because they never bothered to understand the rules. And in my experience, ignorance is always more expensive than any tax rate. Taxes are one of life's certainties, but the amount you pay is not. It never was. The idea that taxes are a fixed bill is one of the biggest illusions in personal finance. People talk about taxes as if they're some divine punishment that can't be questioned, like gravity or aging or your knee hurting when you hit 80. But taxes are not physics. Taxes are man-made. They're rules. Rules written by lawyers. Rules full of incentives. Rules full of odd exceptions. Rules full of opportunities for anyone willing to read more than 3 sentences. The wealthy understand this. The average person does not. And that gap in understanding is where most of the money disappears. I'm not talking about doing anything illegal. I'm talking about using the system exactly as it was designed. The government wants certain behaviors. They want people to invest. They want people to build houses. They want people to start businesses. They want people to save for retirement. So what do? They reward those behaviors with tax advantages. Generous ones. Shockingly generous ones. But here's the funny part. Most people never take them. They don't know they exist. Or worse, they think they're tricks for rich people. And no, they're not tricks. They're tools. Tools available to anyone who's willing to plan ahead, instead of stumbling through life like a drunk sailor. Let me tell you something simple. People who complain about taxes tend to be the same people who never plan for them. They only think about taxes once a year, usually the night before filing, and they expect to win a game they never practiced. Imagine playing bridge like that, or poker, or golf, or anything. You'd get crushed. It's the same with Texas. You can't play well if you never look at the rules. The wealthy, on the other hand, treat taxes like an ongoing strategy, not an annual chore, a strategy. They know taxes will likely be the single largest expense of their lives. Bigger than food, bigger than housing, bigger than health care. So they do the rational thing. They optimize it. You'd think that idea is obvious. It isn't. Most people spend more time comparing prices at the supermarket than thinking about their lifetime tax burden. They'll drive across town to save $2 on a gallon of milk, but they won't spend 30 minutes learning how to save thousands on capital gains. People love small savings because they're easy. They ignore big savings because they require thought. But in life, the big money is always in the big decisions. Tax planning is one of those big decisions. Here's something else you should know. The tax code isn't a moral statement. It isn't trying to punish you or reward you. It simply reflects incentives. You get tax benefits for owning a home. You get tax benefits for investing long term. You get tax benefits for providing housing to others. You get tax benefits for starting a business. You get tax benefits for building wealth, instead of consuming every dollar you earn. Isn't that interesting? The behaviors that build financial security are the same behaviors that receive the best tax treatment. In other words, the tax code is basically telling you, if you behave rationally, you win. But rational behavior isn't common, and that's why these tax advantages end up benefiting the minority who actually pay attention. Let me be blunt here. If you ignore taxes, you're volunteering to be poor. You're handing money to people who understand the system better than you do, and they will take it happily. One of the greatest financial advantages of my life came from simply not being stupid. I avoided the dumb mistakes that everyone else made. And one of the dumbest mistakes you can make is failing to consider the tax consequences of your actions. Before I buy anything, I think about taxes. Before I sell anything, I think about taxes. Before I structure anything, negotiate anything, or sign anything, I think about taxes. It's not paranoia, it's rationality. Because taxes, unlike the stock market, are predictable. You know the rules. You know the consequences. There's no excuse for ignoring them. People ask me how to get rich. I tell them the same thing. Avoid stupidity. Avoid unnecessary losses. Avoid letting the government take more than it's legally entitled to. That alone will put you ahead of 90% of the population. Taxes are not the enemy. Ignorance is. And if you eliminate ignorance even a little, you'll be shocked at how much money stays in your pocket. The rich understand this. That's why they stay rich. The rest, they keep playing a game they never bothered to learn, and they wonder why they keep losing. Most people buy a house because someone told them it's the American dream, or because their parents said renting is throwing money away, or because a real estate agent promised them they'd build equity. All of that may or may not be true, but I'll tell you the real reason the primary residence is valuable. The reason the wealthy treat it like a strategic weapon instead of a sentimental purchase. It gives you one of the most generous tax breaks ever written into law, and almost no one uses it intelligently. Let me explain something simple. When you sell almost any asset, stocks, land, businesses, you pay capital gains tax on the profit. That's the deal. You make money, the government wants a slice. But your primary residence is different, very different. If you're single, the IRS lets you keep the first $250,000 of profit tax-free. If you're married filing jointly, it's $500,000. You don't owe a penny in capital gains tax on that amount. Not one. Do you know how generous that is? It's absurd. It's practically a gift wrapped in legal paperwork. And the only real requirement is to live in the home for 2 years. 2 years. That's it. You don't need to be a genius. You don't need to be wealthy. You don't need to hire an army of accountants. You just need to know the rule exists. Most people don't. Here's where things get interesting. Imagine adding $500,000 to your net worth without paying any tax. Do it twice and you're a millionaire. Even if you never invest in anything complicated, and yet the average person lives in one house for 20 or 30 years, pays interest, pays maintenance, pays insurance, and never once considers how to optimize the tax side of ownership. They treat their house like a museum, something to sit in, something to decorate, something to emotionally attach to. The wealthy treat it like a movable financial instrument. You see the difference? People ask me, Charlie, isn't this taking advantage of the system? No, this is the system. The government created the exclusion on purpose. They want people to buy homes. They want stable neighborhoods. They want families to build wealth. So they reward the behavior that produces those outcomes. But let me tell you what usually happens instead. People buy houses at the top of the market. They overpay. They borrow more than they can handle. And when it finally appreciates after 10 years, they're so relieved they just stay put. They never capture the benefit the tax code practically begged them to take. Now let's talk strategy. There are two main ways ordinary people extract massive tax-free gains from real estate. Buy a home that needs work. Add value. Live in it for 2 years. Sell it. Keep the profit tax-free. This is the most common method families use, without even realizing they're playing a tax optimization game. Buy below market value in a great location. No hammer, no renovation TV show, no sweat equity, just intelligent buying. Find a place that's undervalued. Hold it. Let the market do the work. Sell after 2 years. Again, keep the gains tax-free. Is this easy? No. But it's not astrophysics. It's basic competence. Something most people could do if they stopped treating their house purchase like a romantic decision and started treating it like a financial one. Now here's a bit of Munger-style bluntness. If adding $250,000 to $500,000 of tax-free profit doesn't interest you, you're allergic to money. But the reason people don't use this advantage isn't lack of interest. It's a lack of awareness or lack of discipline or lack of willingness to move every few years. The wealthy don't suffer from those limitations. They will gladly move if the math makes sense. They treat mobility as a feature, not a burden. And I assure you the math makes sense. Here's the irony. The people who could benefit the most from this exclusion. Middle-class families are often the ones who ignore it completely. They buy once. They stay forever. They let the tax break gather dust. That's what I call an unforced error, a loss caused by inertia, not misfortune. The difference between being comfortable and being wealthy often comes down to eliminating these unforced errors. Before you buy a home, ask yourself a simple question. Am I using this asset the way the tax code intends me to? If the answer is no, you're leaving free money on the table. And free money in my world is the rarest thing in existence. One last thing. People love to say, the rich get all the tax breaks. No, the rich use all the tax breaks. The breaks were there for everyone. The rich simply bothered to look. The tax exclusion for a primary residence is not a loophole. It's not a trick. It's not a secret. It's a law, a very generous law. And if you ignore it, the only person to blame is the one in the mirror. People love to complicate investing. They chase exotic strategies. They gamble on things they don't understand. They day trade like they're auditioning for a job at a hedge fund. Most of them lose money, of course. And yet the simplest, most reliable tool for building long-term, tax-efficient wealth has been sitting right in front of them for decades. It's called the Roth IRA, and it's one of the rare cases where the government actually rewards you for being prudent. Let me explain this in the most unromantic way possible. With a Roth IRA, you pay taxes up front. Money goes in already taxed. But everything that grows inside the account, every dividend, every capital gain, every compounded dollar, comes out tax-free. Read that again. Tax-free. This is not a gimmick. It's not a coupon. It's one of the few deals in life where the government steps aside and says, fine, keep it. If you think that's insignificant, you haven't done the math. Most people underestimate the brutality of taxes on long-term wealth. Let's say you invest for 40 years. Every time you sell, every dividend, every rebalance, every withdrawal, you lose a slice to taxes. And like anything else in life, small bites become big chunks over decades. With a Roth IRA, none of that happens. Compounding is allowed to do its job without interference. And compounding without interference is a superpower. But here's the strange part. Most people ignore it. They say, well, I don't get a tax deduction this year. And then they pat themselves on the back for being financially responsible. This is the kind of small thinking that keeps people mediocre. They trade a little benefit today for a massive benefit later, simply because the later benefit requires patience. Let me give you a principle that has served me well for almost a century. The world rewards long-term thinkers and punishes short-term ones. The Roth IRA is designed for the long-term thinker. It's literally a bet on your future tax burden. And here's the irony most people miss. If you expect your income in retirement to be high, then a Roth IRA is a no-brainer. Most retirement accounts, traditional IRAs, 401ks, delay the tax bill. They don't remove it. They simply shift it. And when you retire with a large portfolio, the IRS will want a bigger share. With a Roth IRA, that problem never arrives. Not at 60, not at 70, not at 90. In fact, the government doesn't even force you to take money out. There are no required minimum distributions. You can let the account grow for as long as you want. You can pass it to your heirs. It's one of the cleanest vehicles for transferring wealth tax-free. Now let me say something unpleasant but true. Most people have no strategy for taxes in retirement. None. They simply hope they'll pay less because they'll live on less. We have that's wishful thinking disguised as planning. If you invest well, you'll have more income in retirement than you expect, and the government will tax it more than you prefer. This is not complicated. It's predictable. The laws are written in plain English, but predictability is useless if you don't act on it. A Roth IRA is the cheapest insurance policy against high future tax rates you'll ever get. Yet the average person contributes nothing. Zero. They say they can't afford it, but they can afford new phones, new subscriptions, new distractions. You can always afford your priorities. You just can't afford your excuses. Let me tell you what very few people understand. Tax-free compounding is the closest thing to magic the financial world offers. Every dollar inside a Roth grows without friction. Every reinvested dividend gets to stay. Every market gain becomes permanent. And over decades, that simplicity becomes overwhelming. People love complex strategies. They think complexity must equal sophistication. But the truth is the opposite. Simple strategies executed for long periods beat complicated ones executed poorly. A Roth IRA is simple, painfully simple. So simple that people ignore it because it lacks excitement. But here's a rule I live by at Berkshire. Boring wealth beats exciting poverty. Most people choose the second option. They don't do it intentionally. They drift into it. They chase shiny objects. They skip the basics. They avoid the unglamorous work. And then 30 years later, they wonder why their retirement depends on Social Security instead of their portfolio. If you want to avoid that fate, you don't need brilliance. You need consistency. You need patience. You need a Roth IRA and the discipline to fund it every year. The government designed the Roth IRA to reward those who think ahead. Take the hint. Because here's the truth. If you can't take advantage of a tool this simple, you're not going to take advantage of the complicated ones. And if you can't do the simple things right, don't expect the financial gods to save you later. If you want to understand why wealthy people love real estate, don't start with rent checks. Don't start with appreciation. Don't even start with leverage. Start with taxes. Real estate isn't attractive because it's glamorous. It's attractive because the tax code treats it with a level of generosity that borders on comical. Let's begin with the strangest part. When you own a rental property, the IRS allows you to claim that your building is wearing out over 27 and a half years. That's called depreciation. Now here's the funny part. The building might actually be gaining value. The neighborhood improves. Inflation lifts replacement costs. Demand increases, but the IRS still lets you pretend it's deteriorating, like an old shoe falling apart in slow motion. And that illusion, this polite fiction, is worth a fortune. Suppose your rental building is worth $500,000. Divide it by 27.5 years. That's roughly $18,000 in depreciation deductions per year. Let me translate that. You get to reduce your taxable rental income by $18,000 for a building that very likely isn't falling apart at all. This is why I sometimes say the tax code was written by people with a strange sense of humor. They reward you for an expense you never actually paid, and depreciation is just the opening act. Almost every cost associated with a rental property is tax deductible. Property taxes, insurance, repairs, pest control, landscaping, management fees, legal fees, and of course mortgage interest, often the biggest piece. By the time you add up all these deductions plus depreciation, your taxable rental income can easily fall to zero. Zero. Not because the property didn't make money, but because the tax code allows you to calculate income in a way that favors you. This is one of the rare moments in life when the system is rigged in your favor. Naturally, most people never take advantage of it. They say real estate is too much work or too risky or too intimidating. Fine, but don't complain later when you see landlords paying far less tax than employees. It wasn't trickery, it was competence. Now let me tell you the part that separates amateurs from professionals. Depreciation isn't entirely free. If you sell the property, the IRS may want some of it back. That's called depreciation recapture. Most people don't realize this. They think depreciation is pure profit. It isn't. But here's where the intelligent investor outmaneuvers the tax man. You can avoid recapture by doing a 1031 exchange, a perfectly legal mechanism that lets you roll your gains into a new property without paying taxes. You're deferring the tax into the future. And the future is where clever people like to move unpleasant things. Remember what I said earlier? The rich don't evade taxes. They postpone them for so long that occasionally they never pay them at all. If you hold real estate until you die, your heirs receive it with a stepped-up basis, meaning all your lifetime gains vanish for tax purposes. You enjoyed rental income for decades. You enjoyed depreciation deductions. You enjoyed leverage. And then you exited the game tax-free. That's why wealthy families don't just own real estate, they keep real estate. You'll notice something about all of this. Nothing here is secret. Nothing is hidden. The tax code openly encourages property ownership. Why? Because society needs housing, and the government would rather incentivize private investors than run apartment buildings themselves. So the incentives are enormous. Yet the average person focuses on tenants, repairs, clogged toilets. They obsess over inconveniences. They ignore the mathematics. But the wealthy, they think in systems. They think in rules. They think in cash flows. They don't look at a rental property and see headaches. They look at it and see predictable income, tax-deferred growth, tax-reduced earnings, tax-free refinancing, and tax-free transfers of death. You tell me which is more important, a broken faucet or 40 years of compounding after taxes. People focus on the wrong things. It's a disease. Let me be blunt. If you can't treat a rental property like a business, don't buy one. But if you can, you'll find that the tax code bends in your direction, like a tree leaning toward sunlight. One more thing. People ask whether real estate makes you rich. Not by itself. Bad buying makes you poor. Bad management makes you miserable. But bought intelligently, managed competently, and structured tax efficiently, real estate is one of the cleanest paths to wealth. Not exciting wealth, not Instagram wealth, but durable, compounding, tax-optimized wealth. The kind that stays with you and stays with your children, and sometimes stays with their children. There's nothing magical about it. Just incentives, just math, just patience, and the humility to let the tax code work for you instead of against you. If you really want to understand why some people accumulate wealth effortlessly, while others struggle for decades, start by examining one simple difference. Employees pay taxes first. Business owners pay taxes last. That one distinction explains a tremendous amount of financial inequality in the real world. Most people don't realize this. They think the rich must be doing something scandalous, some conspiracy, some backroom deal. No, what the wealthy understand is embarrassingly simple. They understand sequence. Employees follow this sequence. Earn, tax, spend. Business owners follow this sequence. Earn, spend on legitimate business costs. Tax on what's left. That reversal changes everything. When an employee earns $1, they might only keep 60 cents. Sometimes 50, sometimes less, before they buy groceries, before they pay rent, before they drive to work in the first place. The government takes its cut instantly. But the business owner, they earn $1 and they get to spend that dollar on the things required to operate their business. Often things they would have paid for anyway if they were employees. A car, a computer, a phone, internet, software, travel, training, a portion of their home office, meals related to work, professional services, equipment, tools, marketing, insurance, hiring help. All legitimate business expenses, all deductible, all reducing taxable income. The employee and the business owner might drive the same car, use the same laptop, and drink the same coffee. Only one of them gets to deduct those costs. And people wonder why business owners end up with more money. It's not magic, it's structure. The tax code doesn't favor the rich. It favors productive activity, risk-taking, value creation, entrepreneurship, job creation. The system rewards the people who create the economic engine, not the ones who merely operate inside it. And before someone gets offended, let me clarify. There is nothing morally wrong with being an employee, but there is something financially dangerous about staying blind to the rules that govern your financial life. Employees often think the game is fair. It isn't, but it's not unfair because someone cheated. It's unfair because someone else read the rule book. Now let me tell you a story I've repeated for decades. People come to me asking how to pay less tax. They want a trick, a shortcut, a loophole. I tell them the truth. You want lower taxes? Start a business. The tax code already gave you the answer. They usually don't like that. It sounds like work, responsibility, risk. Of course it does. That's why the rewards exist. If starting a business required no effort or courage, the tax benefits wouldn't be there. They're compensation for taking on uncertainty. But even a simple side business, legitimate, modest, opens financial doors that a regular W-2 job never will. The moment you become a business owner, even in a small way, you move from a system designed to take taxes from you to a system designed to let you control when and how you pay them. Here's an example. An employee drives to work every day. Wear and tear, gas, depreciation not deductible. The business owner drives to meet clients. Deductible. Same car, same miles, different system, or take a laptop. An employee buys one with after-tax dollars. A business owner buys one with pre-tax dollars. Same machine, different result. Or take education. Employees pay for courses with what's left after taxes. Business owners deduct courses that improve their business. People love to say life isn't fair, but fairness isn't the issue. Knowledge is the tax code is a giant, complicated document, but its underlying logic is straightforward. You get rewarded for building something. You get taxed for consuming something. Employees consume. Business owners build. The code rewards builders. Now, before someone misinterprets this as encouragement to commit fraud, don't. Cheating the IRS is stupidity of the highest order. Everything I'm describing is legal, simple, and explicitly supported by tax law. If you don't understand how to use these rules, hire someone who does. The CPA is not a luxury for the wealthy. It is the toll you pay for not wanting to be financially incompetent. Let me give you one less unpleasant truth. No employee, no matter how smart, how dedicated, or how frugal, will ever beat a business owner who understands taxes. The employee works for money. The business owner works for structure, and structure always wins. This doesn't mean everyone must quit their job tomorrow. It does mean this. If your entire financial life is built on a W-2 paycheck and you have no business ownership, no deductions, no leverage, no control over timing, your taxes will always be higher than they need to be. Not because the government hates you, but because you chose the least efficient system for building wealth. To start something, anything legitimate, a consulting activity, a freelance service, an online shop, a small operation that produces revenue. Once you do, the tax code starts to cooperate instead of taking your lunch money. And that is the difference between watching wealth happen to other people and building wealth in your own life. There's a pattern you notice after you've lived a long time and watched how wealth behaves across generations. The rich don't play the same game as everyone else. And the biggest difference isn't intelligence. It isn't luck. It isn't even work ethic. It's structure. Thank you.